So good morning, everybody. My name's Jeremy Mindell, and this is a K3 Hub, the last K3 Hub CPD session of 2023. And I'm talking on tax for non-tax specialists. And I'm being assisted by Helen and Caroline on this, who will be dealing with all the polls and administration and so on. I've flashed up question one. What are you most interested in today? Pick your top three. And I've got a lot of material, and that material will be available to you. But I won't be able to cover everything. Tax is a very, very wide subject. So I am going to be influenced by what you put on the poll about your top three elements to look at, because I'll emphasize those and de-emphasize other elements. But there are more slides for you to look at. Please feel free to ask questions using the question and answer box. And I'll endeavour to get to those questions as we go along. Please try not to make them too client specific. It is generic information that I'm giving, not client specific. And this is not a substitute for looking at an individual's position or a company's position and looking at their individual facts and circumstances. So as I say, please do fill this in. These are the subjects that I'm looking to cover, but in the inimitable words of George Orwell, all subjects may be equal, but some subjects are more equal than others. Just to go on that basis, a little bit about the purpose of the seminar. So what we're looking at here is the purpose of the seminar. So Q&A. Will there be a recording available afterwards? It is being recorded, so yes, there should be. The seminar looks at compliance issues that would concern HR, finance, sales, business strategy, and company secretarial, as well as remuneration specialists. And it concentrates on areas where the interaction between taxation and other disciplines and specialisms is essential, and looks at the effect of tax on other areas and the effect of other areas on tax on that basis. No, the slides are the notes and they are downloadable. They will be in the chat box shortly. Okay. So, as I said, I'm looking at a number of issues, as you can see on the slide, and the top issues are, perhaps unsurprisingly, deductible and non-deductible expenses, which tie with employment versus self-employment, then capital versus revenue. And the other topics are some way behind. So that's quite useful. So I will spend quite a lot of time on employment versus self-employment and IR35 status, deductible expenses and capital versus revenue. And the other elements I will cover less. The element that is most seems to be least popular is international tax compliance, which is perhaps not terribly surprising. So it'll only get a little slot at the end, but that's very helpful. Thank you very much on that basis. And then the slides for this are on the chat box if you are looking to download them. I think I'd start off with the point about the differences. You've got the format of or the structure of businesses. So if I'm a sole trader, then I have a direct relationship with the customer. I'm taxed on the profits that I make. So I would, if I was a sole trader, I would report the income that I have just as normal income. I'd report the expenses. And on my annual tax return, I would end up with a profit or loss, which I'd put on my tax return. And there are significant advantages to being what I call a sole trader, in that there is a great deal of simplicity to that. Of course, the other type is the incorporated structure, where you have the company sitting between you and the customer, and indeed the company sitting between you and the supplier. And what you do is what we call the classical system of taxation, is that you tax the company at corporation tax rates, could be anywhere between 19% and 26.5%. when you take into account the marginal rate. And then on the amount that the company pays me, either in terms of salary or bonus or dividends or benefits, I'm taxed on that. So a company is a vehicle where you could stack up profits, for example. And if I take very little money, maybe because I want to grow the company and eventually sell it, then that element would be extremely useful from that point of view, in that I can stack up the cash, and if I don't need it immediately, it grows at the lower rate of corporation tax. In terms of the tax impact, if I set up a company, then I'm going to be concerned with not just income tax and national insurance, which I would be as a sole trader, and VAT if I'm above the £85,000 turnover threshold. I'm also going to be very concerned about corporation tax as well. So that's the element for companies, which increases, the amount of elements that I need to deal with. I need to do accounts. I need to get them into company's house, along with tagging between my tax computation known as IXBRL, and an annual return. So there's quite a lot of paperwork, extra paperwork, when you're dealing with a company rather than just an individual trader. And then, of course, there could be business rates as well, something that people often overlook, but obviously business premises will attract business rates as well. So the question which often comes, particularly with landlords, but with others, to incorporate or not. So incorporation, you have a limited liability, albeit not terribly limited these days, as a lot of the protections for corporate protections for directors have disappeared or been eroded. Credibility, certain areas there'll be more credibility. It is a separate entity. Sometimes something that people forget is that even if you own the company entirely, it is still a separate entity. And if the company pays you, that needs to be recorded and accounted for tax. You need to do annual returns. You need to pay corporation tax. Anything that's paid to you in terms of salary would be pay as you earn rather than drawings. And from post-tax profits, you can pay yourself dividends. In terms of unincorporated, you need to look that if that the liabilities are your own personally. You're taxed on the profits, not on the business drawing. So if you don't draw money from the business, you're still taxed on it if you've made a profit. From a cash flow point of view, you pay tax in end of January 31st and 31st of July. So it's what is called a two-spike system. There are less returns to do on that basis. And if you make losses, one of the important things in terms of newish business is that you can claim tax relief on the losses that you make against other income. And that's very useful, say, in the starting period of a business. So quite often businesses start off as one-person bands, and then when they're established and profitable, they move to be incorporated. The process is you've got an idea, it becomes a business plan, and the first thing that you would want to do after the business plan is some sort of cash flow forecast, given that most companies tend to go under as a result of cash flow rather than anything else, and tax is an important part of that cash flow. You want to notify HMRC of the business existence. If your turnover is your taxable turnover, that's turnover, not profits, is above £85,000, you want to register for VAT. And if you're a company, you want to register for corporation tax. In terms of when you start taking on staff or as a company pay yourself salary, you need to register as an employer, register for national insurance. And if you haven't been on that system before, you probably need to register for self-assessment. Certainly as a sole trader you would do. You may not have to do so now under the regulations if you if all your pay is under pay as you earn. How do you do this? Well, you just go on the revenue website and you find the screen for register for HMRC taxes, and it will take you through that on a a fairly systemic basis. Are you registering for self-assessment, including class 2 national insurance, although that is being abolished from, or the compulsory element of that is being abolished from the start of the next tax year. Corporation tax, as I say, pay as you earn, and VAT. And this is the front screen. And then sorry, if you go to next, it'll take you to the next screen that you need to look at. How do I work out profits? So the normal deductions that I'm looking at would be office in home. So at the moment, you're looking at my office in home. So this is where I regularly use for broadcasts when they're at home and work. But I do use it for a mixture of elements. So I'm not getting the full deduction for this room. And that might be a good idea, because if I only used a room for business purposes, I might lose capital gains tax relief on that portion of the house when I sell it. So typically, even if I was using an office, a room predominantly for business, I tend not to use it entirely for business. But I use several rooms, part of them for business storage of documents, meeting clients, where I store my technical books, for example. So there's no room that is entirely used for business, but there are several rooms. And the issue actually for HR with home working is, of course, in terms of health and safety, to make sure that individuals, even when they're working from home, are working in a safe environment, that they have the right tools, that they've got chairs that aren't going to give them backache, that desks are ergonomically designed. All of those issues become HR issues, if nothing else. Then there's transport, public transport, utilities, electricity and gas, particularly at home, heating on a day like this, stationery, subsistence, website development, marketing, telephone, and that could be travel, could be obviously use of a car. Okay, stationery, thank you. That's funny enough, when I read that, I thought, does it have an E? Does it have an R? It does have an E. Okay. Important figures for 23-24. Personal allowance 12,570. A higher rate threshold where you're going to 40% tax, 52,770, not 4. Additional rate threshold 125,140. 60% band, 100,000 to 125,140. Basic rate tax at 20% on that basis. National insurance class 2, £3.45 per week. National insurance class 4, 9%. And then VAT threshold, so the threshold at which you have to pay VAT, £85,000. Corporation tax rate could be 19% for small companies, but of course could be 25% for larger companies on that basis. Once you get past the 50,000 threshold, you're at a marginal rate of 26.5%. And then when you get to 50,000, it drops back to 25%. Class 1 class 1 employer 13.8%, class 1 employee 12, and then it's 20, it then drops to 10% from January 2024 on that basis. So a reminder of what is taxable income. So income, money from the sale of goods. What is not taxable income is loans. Money from the sale of services. Not taxable income is gifts for no consideration. So if I get a loan from a member of the family, or I get a gift towards my business, that is not taxable income. But then the repayment of them is also not deductible. And money from sale of image licenses or image rights would be income. Interest received would be income. Not taxable income would be investment into the business itself. So if I'm a business and I'm looking for loans, gifts, and investments, those are not taxable of themselves, and the repayment of them are generally not tax deductible either. And of course, the element I'll need to think about is taking on staff. So are they employees or are they self-employed? And we're going to look at things such as equipment, advertising, in business on own account, negotiating rates, and discretion on taking on work. Those are badges of being self-employed, and something that I'll look at a little bit, I'll look at now, as this was one of the most popular elements in the poll. So let's look at employment versus self-employment. And here, what one needs to think about is the way that the pattern of work has changed over the last 110 years or so. So if I think about important events, 1911 was when Social Security was introduced. 1944 was when pay as you earn was introduced. So that's David Lloyd George, 1911. 1944, same year as D-Day, is when pay as you earn was introduced. 1978, Class 4 NIC for self-employed was introduced by the late, great, and inimitable Dennis Healy. 1985 was important because that's when the cap on employer NIC contributions was lifted by Nigel Lawson, who died only this year. And very important in terms of widening the gap between the treatment of employed and self-employed individuals. Originally, Social Security was based on a flat stamp. Now it's based on a percentage of earnings, and is higher, even with the current changes, particularly for employees over the self-employed. In terms of significant dates, some of the really important self-employment cases, employment versus self-employment, Ready Mixed Concrete and Hall versus Lorimer. Other elements was the announcement of the introduction of IR35 in 1999, and then its implementation in 2000, 6th of April 2000, same day as my youngest son was born. And we've had it now over 23 years, and it's fair to say that it still has its issues. There was, in the beginning of 2000s, Gordon Brown introduced a 0 starter rate of corporation tax, which encouraged everyone to incorporate, and then they reversed it a few years later. But it had a long-term effect in the number of companies that were created in the UK. 2016, the dividend rate was substantially increased. 2017, the responsibility in the public sector for IR35 moved to the end user rather than the personal service company. So I could set up a personal service company to provide services to the end user. And until 2017, I was responsible for tax and national insurance. Which made it more difficult for HMRC to enforce, because you might have one health authority and lots of contractors. This was then moved to the end user, i.e. the health authority or the bigger company, the bigger national public body, not private, the bigger public body, and that made it easier for HMRC to police, but also meant that because the public bodies were more cautious about this area, HMRC got more tax in. And then in 2021, the responsibility for IR35 moved, as we'll see, to the end user in the private sector for all but small companies, again generating more income for the exchequer because of greater compliance. In terms of significant trends, and this is an element for HR and in particular, obviously there has been over the years significant convergence in terms of work patterns and benefits with the employed. So, the work patterns and benefits received by the self-employed have moved more to what the employees have. And in terms of the employed, their flexibility, working from home, working hours that they determine, their benefits and work patterns have converged, particularly as a result of the pandemic. Why the focus? Well, the government, when they introduced IR35, and then tightened it up in 2017, estimates of loss of about £5 billion by 2021 on that basis. So that was a major consideration. In terms of the costs, you can see the difference in terms of auto-enrollment, apprentice levy, holiday pay, and employer NIC are a significantly higher burden for the employer than having self-employed individuals. Chat. And I think that is what we're looking at, issues in terms of pension auto-enrollment, apprentice levy, holiday pay, and employer NIC. And that is a big factor, apart from the body of employment law. That's a huge factor to make taking on contractors and self-employed individuals a considerably less costly element than taking on employees. The self-employed are cheaper. The self-employed, what are we looking at in terms of this rights in contracts for services? And it's important to distinguish: a contract of service is what an employee has, a contract for services is what the self-employed have. Some health and safety on site, no employer NIC, no apprentice levy, and no requirement for pay as you earn as being self-employed. So when you look again at those elements of convergence, you can understand why HMRC sees that pattern moving. The arrows moved a little bit on that basis, and you have more people who are being determined as being employed, which may be one of the reasons why there's been post-pandemic a significant, again, growth in the number of payrolled staff. In the olden days, of course, it was fairly easy to work out who were employed and self-employed. And indeed, you go back to the 50s and 60s, and 99% of people were employees. They worked in a fixed pace of employment. They would work 9 to 5, hence Dolly Parton there. They would do long years of service for one employer, and they would pay a national insurance stamp. The last part of that, the remnant, is class 2, and that's going, but a fixed payment is what there was until the 1980s, and in return for that you got your pension and some elements in terms of access to other benefits. Of course, in terms of the present way of working, people are much more flexible in their hours, where they work from, and so therefore that flexibility has been afforded to both the employees and the self-employed, and has rather reduced the differentials between them, making it more difficult to determine. But what is my risk if I get this wrong? So if I pay £100,000, what is my risk? Well, potentially 40,000 of tax, employer NIC of 11,000, employee. So that's the employer NIC. NI roughly of £5,000 for the employee, and on top of that, interest and penalties. And therefore, what we're looking, if I pay £100,000, I could have a percentage at stake of around 70% additional, that if I'm found to have paid this money and I should have operated pay-as-you-earn and NIC, I end up paying another 70% on top to HMRC. And note, it's my responsibility rather than the now employees. It was the employer's responsibility to deduct national insurance contributions. If they fail to do so, then they don't just pay the employer NIC, they pay the employee NIC and the tax that should be deducted. And they may not, it is possible that they'll get recourse to some offset over what the employee paid as self-employed income tax and national insurance, but the probability is not. This will be a cost faced by the employer. So this is a major area in terms of tax and national insurance. You may have seen the Kay Adams case, which was finally decided in favor of Kay Adams after 4 lots of court hearings, and she was looking at an additional bill of around £124,000 for her personal service company. Where employment and tax become interlinked are, for example, the recruitment in terms of the drafting of the contract, any inducement payments, benefits, how they're structured, and transfers. Is this a secondment where you move places but retain the same basic employment, or is it a brand new employment? And those elements are very important on those bases. Where you would look at in terms of employment law is you would look at ITPA 2003, which is primary legislation, statutory instruments, regulations, which is still legislation, but is passed in a different and rather shortened manner. So primary legislation gives the authority to the government to publish regulations, secondary legislation, and they can be passed in just an afternoon in Parliament. So whereas primary legislation takes some time, secondary legislation is generally quicker. Statements of practices are non-statutory. HMRC manuals are published online. They used to be private, but with the Freedom of Information Act, they are published with some bits redacted. But again, they're not legislation, but there is what is called the doctrine of legitimate expectation, which allows you to rely on their guidance. HMRC booklets, for example, 480 and 490, which are on travel and subsistence and expenses, very useful. And HMRC websites, we'll talk about one of them, the Check Your Employment Status tool. Are they totally dependable? Well, it depends on the information, the accuracy of the information you put into them. Sources of employment law, of course, are different. We're looking at the Employment Rights Act 1996, which consolidated employment rights going back, would you believe, to the common law Anglo-Saxon ideas such as the mutuality of obligations between the employer and the employee, and the duty of care that each have to each other, other statutes, and employment tribunal case law on that basis. So when I talked about the significant dates, the last two in terms of IR35, 2017, the responsibility moves in the public sector for IR35, so it's the end user, and in 2021 the responsibility in the private sector moves to the end user, except for small companies. So let's look at employment status and the general principles. So what we're looking at is the test. Now, the tests came from a case back in 1968, ready mixed concrete versus the, I think, Secretary of State for Work, or Secretary of State for Labour, but it's called the ready mixed concrete case. And the tests for status would be control. Does the engager have control over the individual worker? Integration, to what extent is the worker's activities integrated into or form a main part of the company's or employer's activities, or are they just an element that is could be seen as a sideshow? Who is taking the risk? Who's doing the pricing? Do I charge a price as a self-employed person, or do I just get the rates that are given and the salary that's paid? Substitution of labor. Can I send a substitute there? Mutuality of obligation. Once I'm taken on, do I have to obey any reasonable instructions and do any work given, or can I choose what work to do? And is the engager, once I'm taken on, obliged to give me work, which is the normal position in terms of an employer-employee relationship, what used to quaintly be known as the master-servant relationship. Whose capital is it? Am I using my own capital in a business, or am I using the engagers? Am I advertising my business, or am I advertising the employer's business? The status of my business, am I dealing with lots of different people or just one or two? And do I actually employ people myself in order to carry out the business for my engager, or do I just do it on a personal basis? And the way that you go through that is you examine the paperwork, then you test it against economic reality, and you would use the HMRC checklists as guidance on that basis. And then you're going to look at the contract. So the starting point is a contract. And oh, I rather like that bounce. Get my children to do things like that for me. A contract is an agreement between two parties. It can be written, oral, implied, or any combination of them. And the starting point for any status review is considering the nature of the contractual relationship. So you start off with the contract, and then you need to consider the facts of the relationship as well as the presented relationship to ensure it is accurate. So in other words, does the economic reality of what I do for the engager, is that reflected in the contract? And economic reality will always trump the paperwork where the two are in conflict. So you don't just look at what it says on the paper, the contract, you see what's actually done. So, you know, just by writing in a right to send a substitute, does this actually happen in reality? It can't be, won't be taken in as a factor if it never happens or never in reality could happen. So when I look at typical structures, and I took to for sole trader working directly for a client, and there the issue is the sole trader really an employee? A limited company providing work for a worker for an end client, that would be within, you would look at whether that's within IR35. Agency providing workers, companies providing workers via agencies when they're involved in that. So that's two steps, and overseas entities providing workers, which could still be within the scope of pay as you earn. In terms of a sole trader working directly for a client, looking at the direct relationship between the individual and the end client, the risk lies with the end client, as they have the obligation to operate pay as you earn if the individual is the employee. Theoretically, the most straightforward scenario, but the one that has been so far fraught with most risk to the end user. Limited company providing the services of worker. Here, IR35 will be relevant and need to consider whether there would be an employee relationship between the worker and end client in the absence of a company. The change in 2017 relating to end client, who is public sector body, as defined in the Freedom of Information Act, as an end client will now make the decision about status, causing huge problems in the market. Did it cause a lot of problems? Well, it certainly created quite a lot of upset at the time, but it did lead to, I think from HMRC's view, more satisfactory compliance activities on that basis. If public sector client must deduct tax on payment to PSC, if not, meet pay as you earn on deemed employment income in the company. But that now is only for the smaller companies. As I said, for the larger companies, they as end user have the responsibility. And you can see, you know, if you were a bank, for example, and you had 1,000 people working on IT contracts, it's much easier for HMRC to go to the bank as one body rather than all the little contractors on that basis. There is this employment status tool specifically for IR35, but it is not perfect on that basis. An agency providing a worker may fall within separate agency legislation. The person contracting with the agency must be an individual. The individual renders personal service to another person, the client. The individual is subject to or to the right of supervision, direction, or control as to the manner of rendering such services. So, although I provide this person through an agency, that they are under the direct supervision and tight supervision of the end user on that basis. And there was legislation introduced, Finance Act 2015, to tackle false self-employment situations on that basis. The limitation on this, the agency legislation does not apply where the contract is between the agency as the company. However, there is no reason why IR35 cannot apply to these arrangements, so that the PSC, in terms of a small company, will have to consider if deemed employment income is to be calculated. And HMRC will also want to check that the contract is genuinely between the PSC and the agency and not between the agency and the individual. So in terms of this, I used to have to look when I was in-house as a UK group employee tax manager. I would have to look at the details of the arrangements to see, you know, who is taking these people on, are they being supplied by an agency, and what is the nature of the work that they're doing. And I would do a 6-monthly review, particularly with the IT department, about what they were doing. And then in terms of overseas agencies, there were a number of people thought that would sidestep the arrangements, but actually that became much more difficult after FA 2014 on that basis, which basically said if you can't catch the overseas entity, we'll catch the entity that's in the UK, even if it's not the agency, we'll catch the nearest agency or a body, might be the end user, and impose a liability on them if they artificially use an overseas agency. Let's look at the characteristics of self-employment: put in bids or give quotes to get work, not under direct supervision when working, submit invoices for the work they've done, responsible for paying their own national insurance and tax, don't get holiday or sick pay when they're not working, which is why self-employed people tend to take less sick pay, operate under a contract, sometimes known as a contract for services or consultancy agreement, that uses terms like self-employed, consultant, or an independent contractor. And of course, as I said, the paperwork is where you start off, but you do need to look at the economic reality of the position. A contractor themselves can be self-employed, a worker or an employee if they work for a client and are employed by an agency. And there's a special scheme for self-employed contractors and subcontractors, working in the construction industry, known as the Construction Industry Scheme. I won't go through that in detail, but just to say that just because you're within the CIS scheme doesn't mean you are automatically self-employed. You could be you could be under what they call a labor-only contract, i.e., where you don't supply materials, and that could be seen as an employment element. So just because you're registered under CIS does not automatically mean that you are outside the employment consideration. Company directors run limited companies on behalf of shareholders. Directors have different rights and responsibilities from employees and are classed as office holders for tax and national insurance purposes. And the issue would be is that some people used to think that they could circumvent pay-as-you-earn if they had multiple directorships, particularly non-executive directors, but that is not the case on that basis. Office holders are often non-exec directors or pension trustees, and if they're paid, they are subject to national insurance contributions and tax withholding as well. Big questions: are you in business on your own account? Who's the name on your business card? Is it you as an independent, or is it the company that you're working for? Now, that isn't just a paper exercise. It could say in the media, who do you represent? You know, I'm from the BBC. Makes it a little more difficult to say that you're an independent contractor. But, you know, there've been lots of cases about presenters in the past few months and in the past couple of years as well. The Kay Adams was only decided this week after having gone to 4 court appearances. She writes a very interesting article about this. There are, of course, exceptions to the rules. So doctors, for example, are employed, surgeons are employed by their health authority, and they're definitely employees. Hence all the disputes between consultants and health authorities about how much they get paid. But even with the term consultant, and they are employed and by a health authority, there is the doctrine of clinical freedom. Once they get into the operating theatre, they are completely autonomous in the way that they deal with patients, in the same way that general practitioners are. But the point about surgeons is that despite being under no control when they get into the operating theatre, they are still employees. If you are on the other element, so are you in front or behind the camera, and indeed of the issues there, and that was a big issue in Hall versus Lorimer about whether you were seen as employed or self-employed. And so this is from a famous film with Walter Matthau, where these land agents were only being paid on commission. You could be on commission only and still be an employee. So that's an important element. You know, if I am employed by a double glazing firm to sell double glazing and I'm only paid on commission, that or a substantial element of my wages are commission, then I could still be an employee on that basis, even though my pay is variable. In terms of a tax process where HMRC is involved, you go to the first tier tax tribunal, then the upper tier tax tribunal, and then the Court of Appeal, and eventually you may go to the Supreme Court. In terms of an employment law process, that is different. So where it's a dispute between an employer and an employee, you would go to the Employment Tribunal, then the Employment Appeal Tribunal, and then the Court of Appeal. And those are in cases where HMRC is not a party to this. So there was a famous case of a plumber who took Pimlico plumbers to court saying he should have had certain employment rights. HMRC was not a party to this, so this went through the Employment Tribunal and went all the way past the Court of Appeal to the Supreme Court. And although this was an important status case, there wasn't an immediate tax element to it. This was about the rights of this individual to receive, I think, correct treatment in terms of being treated. He got dismissed because he wanted to go down part-time and they wouldn't let him. And the question arose about whether he was entitled to certain rights. This was a dispute between the plumber and Pimlico Plumbers, and this went through the employment process. So always to remind yourself, you know, what am I? Am I self-employed, employed, a worker, or working for a personal service company? And as I said, control is important. Who has the power to decide the things to be done, decide the way in which things should be done, decide the means to be employed in doing it, and decide when and where it shall be done. And that's not entirely, you know, sort of every element. You know, if I, for example, which is something I need to remember to do, is to get a chimney sweep to clean my fireplace. He comes, he or she, you know, I phone them up, agree a time, they come round in their van, they've come with all the equipment, which doesn't these days include little children, but does include a lot of technology, you know, in sort of vacuums and different brushes and so on, and all sorts of equipment. He does the work, I pay him, he goes. Of course, he does everything about that. He decides when it should be done because it's subject to his availability. The only thing he doesn't decide is where it shall be done, because obviously it has to be done where my chimney is. But that's almost a pure play example of somebody who is definitely self-employed. In terms of control, is the degree of control without restrictions, and who has the lawful authority to command. So, for example, go back to my surgeons, the health authority has many rights, but it doesn't have many rights in terms of how I carry out the operation. It's quite interesting, the doctrine of clinical freedom. So when I broke my arm about 2.5 years ago, originally it was going to be done by one team of surgeons who were going to put me under a local anesthetic. It then got moved to a different team of surgeons who were going to put me under a general anesthetic. And then it moved back to the team of surgeons who put me under local anesthetic. And, you know, the health authority didn't tell them what to do. It was the team of surgeons who did that. They just told me what was going to happen. The factors, as I say, with self-employed, no obligations to give or receive, accept work. You know, i.e. the engager doesn't have to give me work and I don't have to accept it. I can say I'm going skiing. Can negotiate or set rates. Employed mutuality of obligation. The employer must provide work. The employer must accept it subject to the reasonableness test. If it's an employment situation, I have to do the work if it's reasonable, and the rates are set by the engager, normally salaries. In terms of other status issues, if you're self-employed, you can send someone else to do the job, maybe. You advertise your own business. So I have my Mindell website, for example, and you have a real risk in making a profit or a loss, either from having to correct work or things not going right. With the employed, no substitutions are allowed. Your employer advertises and you probably receive a set amount of remuneration, because as I say, you could receive bonuses, commissions, and other elements. The important element about this is that there is no silver bullet. There is no one element. After a case called Echo and Express versus Tatton, some people thought that all you had to do was put in a right of substitution into the contract. Even if it was not used, you would have created self-employment. So another case involving Glasgow teachers disabused people of that particular point. Someone else, so in terms of sending someone else, you can do it, but you need to think about, you can and you do it in practice. And that's important. Just having a right of substitution in a contract isn't enough. And in terms of for whose benefit is this cui bono, in terms of advertising, is it you or is it your employer? And who is negotiating rates in terms of what you do? Taxpayer defences and HMRC options responses on this. So if my defence is, well, I got flexible working on hours, the response is, ever heard of 0-hour contracts? So HMRC's response, I can send someone else to do the job. Have you actually ever done this? I pay for some equipment, so do lots of employees. Other elements, I might say, I do not work full-time, you might say, as a defence, and HMRC's response might be, ever heard of part-time and casual work? I get variable pay, lots of salesmen get bonuses and commissions, but are still employees. The company and I agree we are self-employed, but what are the actual conditions under which you work? So in finishing this off, before we take our first screen break, in terms of IR35, remember what IR35 seeking to eliminate is paying salaries to family members to absorb their tax allowances and low rate tax bands, utilizing the corporate tax rules for expenses and capital allowances rather than the less generous reliefs available to employees, and maximizing pension contributions in ways which are inaccessible to individuals. So, you know, can I leave my money in my company as a sort of lower tax haven, taxed at either CT rates of 19% or 25%, or the marginal rate of 26.5%, rather than paying, say, 40 or 45% plus national insurance? IR35 seeks to stop people obtaining a deduction against other income for interest on funds borrowed to invest in the business, retaining surplus funds in the company to take advantage of low corporation tax rates, and access to a 10% rate of capital gains tax on the disposal of the company's shares, i.e. business asset disposal relief. What's to stop me then just building up the money, dissolving the company, members voluntary liquidation, and just taking out the proceeds and claiming BADR, business asset disposal relief, with the lower capital gains tax rates? The golden rule is that an engagement would be seen as a relevant engagement, but for the use of personal service company. And so in other words, if I didn't impose a personal service company into the arrangement, so I have an arrangement with, say, the BBC to provide them with services, and if without the personal service company, Jeremy Mindell Productions Limited, without that, I would be seen as an employee of the BBC, then you ignore putting in the company and you treat it under IR35. So just the imposition of an intermediate company should not change my status. I should look at the underlying facts of the relationship. And this could be the end user or client, the PSC, and the individual on that basis. So I put in a PSC. What you need to do is, if I take out the PSC, do I have a relationship that would look like employment if I take out the PSC? And then with the agency, I need to look at the agency rules. As I say, in terms of the responsibility for IR35, what is known as off-payroll working, moved to the private sector in April 2021. Small organizations are exempt, minimizing the administrative burdens for the vast majority of engagers. In terms of what is small for the purposes of the Companies Act, and now in the off-payroll working section of IT per 2003 requires a company to meet 2 out of the 3 the following: turnover of less than 10.2 million, gross balance sheet assets of less than 5.1 million, fewer than 50 employees. If that is the end user, where the engager is small, the IR35 rules are unchanged, and it is the personal service company that remains responsible for determining whether they're within IR35 and making sure that if they are within IR35, that the correct deductions are imposed on that basis. So you can see that where the end user is small, the end user doesn't need to worry about it. It's still the PSC. But for organizations like banks, consultancy firms like, the big accountancy firms and lawyers and so on, you can see that the responsibility has moved to the end user. Finally, a case, recent case that shows some of the elements. So Adrian Chiles set up a company called Basic Broadcasting Company, and this was about whether Adrian Chiles and his PSC, the Basic Broadcasting Company, was caught by IR35 between April 2012 and April 2017 in respect of his contracts with the BBC and ITV. HMRC contended that he was, and issued, you can see the amount of money, IT and NIC determinations for 1.7 million. Mr. Chiles appealed to the ITT. In this basis, they look back at the ready mixed concrete case, 1968, that I talked about, and this is the mutuality of obligation. And the tribunal determined that for there to be mutuality of obligations, all that was needed was for some obligation on Mr. Chiles to work and on the TV companies to pay for this. As this existed, that element was satisfied. The second test was control. The FTT found that although there was little specific control, there was general control, so this limb was also satisfied. The third test, which was the get out of jail card, the FTT found that on the facts that Mr. Chiles was in business on his own account, so he was not caught by IR35. Factors that they took into account for limb 3: Mr. Chiles hired his own personal assistant. He used an agent whose job was to find him work and promote his reputation and career. He developed and pitched several of his own ideas to other television broadcasters. He frequently wrote columns for multiple national newspapers, and he provided his services to around 25 additional clients. And although the majority of Mr. Chiles's income came from the BBC and ITV contracts, approximately 75%, the FTT accepted evidence that these contracts represented less than half, 50% of Mr. Chiles' working time, and he did employ people to help him with his business. So standing back and looking at all these factors, the FTT held that they demonstrated that Mr. Chiles was in business on his own account, and ITV and BBC were 2 of many clients of his business, and this was inconsistent with the finding that there was a deemed employment, so Mr. Chiles won his case. What is important about this is that I would say that in terms of HR, finance, strategy, and so on, is to make sure that these arrangements that you have with consultants are reviewed every 6 months on that basis. And obviously, the longer that somebody has an engagement, the more likely that this will come under challenge from HMRC. But having a system in place to review, looking at those sorts of elements, that I think is very important on that basis. I may, if I get time, look at the check your employment status tool, which is quite, I think, helpful in terms of filling in the facts and getting HMRC's determination, albeit just on a computer, about the likelihood of whether you're going to be seen as being in employment or self-employment. Okay, at this point, let's take a 10-minute screen break. Hey, did anyone have any questions? Can you hear me? Sorry, somebody could. Helen, somebody else, can we just check you can hear me? Ooh, good. Great. Okay. Great. Fine. Great. I don't need anyone else to answer on that. Fine. Thank you very much. So okay. So capital versus revenue. And if you want to know why we have the system we do, the differential between capital and revenue, you might well go back to 1799, which of course was the start of, when Napoleon took power. So the Napoleonic Wars, some of you might have seen this film. I'm due to see it this weekend. But this is when income tax was first introduced in order to fund the wars against the French. It was a hypothecated tax, as you might be interested in terms of it was a tax which was only put in order to fight the war. And when the war ended, income tax was abolished. And indeed, there was the Peace of Amiens that lasted all of 16 months. And then there was then it ended a second time after Waterloo. So in 1816, income tax was abolished. Now, the issue was that in terms of this, because income tax was seen to be a temporary tax, and as I say, it was abolished twice, what you had is a situation where there was a distinguishing between the revenue expenses. So take the example on the right, which is agriculture, which was, of course, the main industry that employed people back in the 1800s. There was a distinguishing between the hay and the feeding of animals, which would be seen as revenue and therefore expensed during the time that there was income tax, and a barn which could last hundreds of years. And the point was why should you get the full expensing of a barn when you'll get the benefit well after income tax is abolished? So this is why if you look at these sort of tests, the historical tests still important. Whatever apparatus is used by a businessman for carrying on his business, not his stock in trade, which he buys or makes for sale, but all goods and chattels fixed or movable, live or dead, which he keeps for permanent employment in his business. And this is back to a case that predates corporation tax. This is when companies were taxed as a schedule of income tax, Yarmouth versus France. So you could get, and then you would look at the definitions there. So in permanent employment, you'd look at knives and laths, which had an average life of 3 years, held to be plant. And a functional test, the functional test provides the criterion to be used. Is the subject matter the apparatus or part of the apparatus employed in carrying on the activities of the business? Benson versus the Yardarm Club, 1979. So the question would be, is it capital revenue? If it's capital, is it a tax nothing, or is it eligible for a capital allowance? What qualifies for capital allowance is, well, plant and machinery. Machinery is easy, plant is difficult. And the litmus test is the function element on that basis. What is the function test? Does it do something? That's not the right question. The right question is, does it function as an apparatus in the trade, or does it merely function as part of the setting? And that would be the default element. So why is that important? Well, you could get something which is seen as a setting in one place, but performs a function elsewhere. Let's take an example. A grain silo is a business, performs the function of drying grain. It doesn't just store it, it dries it, and therefore on that basis performs a function in the agricultural business. And there's a famous case called May, which means that it qualified as plant. Scottish and Southern Electricity built a hydroelectric plant near Loch Ness, and the head race and trace races, which had water running through them to keep the turbine going, to make the turbine turn around and therefore create the electricity, they were seen as plant and therefore fully deductible, a case that has only just recently been at the, I think, Supreme Court, decided in favor of the taxpayer. In terms of, is it a function or is it a setting? Does it, if, for example, I have the hospitality business, then the decorative elements on the walls of, say, a pub, look at a case, Scottish and Newcastle breweries versus commissioners of inland revenue, they allowed even gnomes, ducks, flying ducks, and all sorts of elements. Very interesting case in terms of being part of the function of the hospitality business on that basis. Q&A. What about office furniture? So office furniture would normally be seen as part of the plant, but the office itself, you know, sort of the carpets, walls, and so on would not. The question would be is, are they fixed to the room? And in terms of that, for example, partitioning walls that are moved back are considered as plant, but permanent walls are not. So, as I say, most office furniture, particularly if it's movable, would qualify for plant and machinery. So, you know, chairs, desks, all those sorts of things. Capital allowances are deducted from trading income, so you deduct them from your profits. Allowances are also available where the qualifying activities other than trading are carried on, and that includes a property business or the managing the investments of a company in an investment business. But in terms of capital allowances, they're allowed for generally just for commercial buildings. The only residential buildings where you get capital allowances are furnished holiday lets. You can get a replacement of business equipment allowance for buy-to-let landlords, but not capital allowances, generally speaking, and that means you can't get it on new items put into the property the first time. It can only be on replacement items. But landlords can claim for both commercial and full furnished holiday lets. So in terms of establishing whether the works are revenue for tax purposes, necessary to consider several issues. Firstly, only subsidiary parts must have been renewed rather than replacing substantially the whole of the entirety. Also, the asset must have been replaced with its like for like or near modern equivalent rather than being enhanced and improved. And there's an interesting element there. If I replace single glazed windows with double glazed windows to meet the energy requirements or rewire to meet new safety standards, they would be allowed actually as revenue expenditure. Whereas if I am replacing something with something hugely better, then or materially better, I should say, then that would normally be seen as capital. Areas of difficulty in practice would be, for example, so alteration, improvement of an asset, notional repairs, assets improved instead of just repaired, no deduction for what had been spent on repairs. So what the example there would be, for example, what I'm looking at there would be different materials. That could be okay. But let's say I had a leaking roof, and instead of repairing the leaking roof, I actually do an extension on the top. I can't get a deduction for the notional repairs on that basis. What I can get is modern technology, replacing wood with UPVC, single glazed windows replaced with double glazed, or imperial storage tank replaced with a metric one could be an example. How about replacing a very large driveway? I'm just about to come to that as an example very shortly on that basis. So I will look at that one. So I will look at that very, very soon. So let's look at these examples in practice. So here I've got a driveway, Steadfast Manufacturing and Storage Limited versus HMRC. So the appellant leased a factory and yard. The latter had not been resurfaced before the site was acquired and was in poor condition on that basis. So what have I got? Some areas were unsuitable. And therefore, on that basis, because they were unsuitable, what I'm looking at is something which is a potentially difficult issue on that basis. So, you know, I've got a driveway, uses forklift trucks, and therefore the pebbling didn't work on that basis. So some areas were unstable and unsuitable for use by forklift trucks, although on that basis, what I'm looking at there is they were used when necessary to turn the trailers for articulated lorries. As these areas were used less often than other areas of the yard, weeds grew through the surface area such that in overhead photographs the areas appeared green rather than paved. Historically, the yard was repaired twice a year by patching with gravel, and the forklift trucks in particular would quickly dig into this material with their tires. As this patching was becoming less effective, it gave rise to health and safety concerns, and the company decided that the yard should be resurfaced. Okay, so the work was undertaken as a single project. As well as resurfacing, a drainage channel was added between the factory and the resurfaced area to stop water from running across the yard and to allow an expansion joint for the concrete. The cost of this channel was only £740. Overall, there was no increase in the size of the usable yard and no increase in the load-bearing capacity of the yard. The total cost of the works was approximately £74,000. Was the expenditure capital or revenue in nature? So this is the case. What I want you to do is answer the question on that basis. What do you think? Was it revenue? Was it capital? And I'll give you a minute in order to do that. Have a think about it. And, you know, the HMRC took this case, so they thought it was capital and therefore not deductible. Steadfast thought it was revenue. What do you think? And you've got a minute to decide. Oh, fairly close here. 54% revenue and 46% capital. So 54 to 46, not quite the 52-48 normal split decisions in this country, but very close. And the answer that was given by the courts was, of course, that it was revenue. And the FTT decision, so a slight majority in its favor on that basis. So let me deal with this point, and then I'll deal with the question. There was no improvement in the yard compared to its original condition, and the works only returned the yard to its previous standard. There was no increase in the usable area compared to the original. There was no evidence of any increase in the load-bearing capacity of the yard. HMRC had argued that expenditure was capital because there would be no need for further repairs for up to 20 years, but prevention of the need for future repairs simply meant that the job had been done well in the first place. If HMRC were correct, most repairs would be treated as capital, which is clearly not the case. And the additional drainage channel of 740 quid was only 1% of the total amount. It was in a minor addition to the works, and there was no evidence that it made a substantial difference to the yard or factory, and therefore the appeal was allowed on that basis. Everyone happy with that? So there was a question, would the same apply if through a rental business? The answer was revenue. So Steadfast Manufacturing won, and the answer was revenue. So 54% of you were right on that basis. And the question would be, would the same apply if through a rental business rents a number of units on the land? And I would argue the answer would be yes, it would still be seen as revenue expenditure and therefore fully deductible. Here's a question, law shipping. So this is a classic element of assets purchased in a dilapidated condition. Law shipping versus CIA. CIR, the ship bought, Lloyd's survey overdue, repairs carried out when voyage completed, purchase price reduced, could not be used to earn profits without repairs, and no evidence of accountancy treatment. So I'll give you the answer on this one. It was bringing an asset back into use that couldn't otherwise be used, and that was seen as capital. And that's one of the classic cases. The other case was this Odeon Associated Theatres versus Jones. Cinemas bought, backlog of repairs due to the World War. And why is this? Well, this is another classic case. And what was shown here was that the capital element, so HMRC argued it was capital and not deductible on that basis. The price was not depressed, could be used profitably from purchase. And this is important. So they were, the standards required in terms of cinemas were a lot less after the Second World War than they are now. People generally didn't have television, so they would go to the pictures twice a week. At least my parents would talk about that, because after televisions only really came in from about the mid-50s, or wide scale use from the mid-50s. And the accountancy treatment, and this is another point for the importance of tax and accounting talking to each other, is the starting point would always be the accountancy treatment, and the accountancy evidence said it was revenue expenditure on that basis. So unsurprisingly, that was seen as revenue, whereas law shipping was seen as capital. Why is it important? Well, because it's still used as a guidance for HMRC in terms of the case law that they use. HMRC's view, capital revenue is a question of law to be determined in the light of the facts of an individual case. No single case. Authorities identify approach and relevant factors. A question is not to be determined by accountancy evidence, but it is informative, not necessarily determinative. So it starts you off. It's a bit like when we were talking in the first bit about employment versus self-employment. That was informative, but not determinative. And obviously there is a fair amount of statute law requiring accountancy treatment to be adopted for tax as well. So, and also companies will determine, you know, what level expenditure. So minor expenditure will almost always be revenue, whereas there will be a threshold at which you need to consider whether it is capital. Here's one, polythene pipes. So this was plastic introduced into pipes, and this was about whether there was a replacement of a full entirety of an asset, part of an asset, or just subsidiary parts. Here's a case, Transco PLC versus Dial. Insertion of polythene gas pipes into old iron ones. No change in the gas, only about 1% of the network was replaced each year, and that was seen as revenue expenditure. Whereas when we think about Auckland Gas Company Limited versus New Zealand CIR, why are we looking at a New Zealand case? Well, because they have common law, same as us, and also quite a lot of their cases until recently went, their Supreme Court was our Privy Council. So that's a sort of legacy of Empire stroke Commonwealth on that basis, that even though they got independence in 1931, de jure independence, they would refer cases back to the Privy Council in London as the Supreme Court for quite a long time. In this case, the insertion of polythene gas pipes into old iron ones was the same, but there was a material improvement, i.e. you could get higher pressure gas. So if you looked at the Steadfast manufacturing case, it was just restoring the yard to what it had been before. And therefore, on that basis, because it was just restoring the yard to what it had been before, they was seen as revenue expenditure. Here, what you're doing is actually producing something or spending money, which it results in a substantial improvement. They're also doing it quite fast, 23% of the network replaced over 5 years, and that was seen as capital expenditure. Any questions on that? Major air conditioning repairs. So I've been asked about major air conditioning repairs. So the question I think would be is how major is it? So I might look at the percentage I'm spending on repairs as opposed to the total value of the air conditioning. So if and I work for I don't work, I don't get any money for it, but I've got a charity with a large building, and they have an annual contract for air conditioning servicing. That would potentially include repairs that are done, so not just the cleaning, but repairs that are needed. And I would say under a service contract, that shouldn't be a problem. If in terms of the repairs, you're looking at it costing more than 50% of the capital, I would be looking at the amount replaced. And is it effectively a replacement of the whole system? Or is it something that's just bringing the existing system back up to the shape it should be? So to a certain extent, Uto, I would say it depends on the size of the repair element. Does that make sense, Uto? So The next point is why employment taxes matter. So it's a short bit on this, but if you look at why employment taxes matter, I mean, you know, employer gives £1,000 to the employee pays income tax at the top rate, £450, employee NI 20, so 2%, employer NI 138, total costs 470 for the employee, 138 for the employer. The net to the employee is £530, so just above 50%. But if you look at it, it's £1,138, which is then producing 530. So if I take into account the employer NIC charge, I've got a 53.42% leakage. Actually, that isn't always, you know, internationally comparison wise. Once you take into account Social Security, that's not necessarily a bad figure compared with continental Europe. You will find that the rates of French Social Security and Belgian Social Security are in particular considerably higher than the UK's. And so therefore, whenever I'm looking at costs, what I need to put in to the funnel and what I get out, what you can see there is that I am actually getting out on that basis a fairly high leakage, in that more than 53% of what is put in goes to HMRC on that basis. So that's an important element. If you look at it, they are expensive. Even for basic raters, again, this is quite expensive. I mean, you've got £200, employee NIC 120, due to go down to 100 when the NI rate falls January 2024. Total cost 320, net to employee 680. The employer is still paying £138. So if I look at that, my 1138 for the normal, what I call the Tommy Atkins of this world, the basic rate taxpayers, Tommy Atkins was the idea of the man on the street. What you're looking at is it's still a 40% leakage rate, which is quite expensive. Why is employment so important? Well, as I would say, small changes, large consequences on that basis. So one of the elements you'll need to think about, and this is particularly HR, would be if I have a temporary workplace, I might get detached duty relief. Secondments are definitely more advantageous in normal circumstances than a brand new employment. Spend less than 183 days in a country, I might get tax treaty relief. Less than 24 months in a place as part of a temporary assignment, I may get, again, detached duty relief. Non-UK domicile might give me home leave tax-free. Tax approved or tax advantage share schemes, also very useful. And if I don't remit funds that are not that are only subject to tax on a remittance basis, then I could end up with an advantage there. Whereas full tax and NI charge, we're looking at a permanent workplace, new employment, greater than 183 days, 24 months in place. All of those elements would give me a probably higher charge, and things I need to think about: UK domicile, taxed on worldwide income, non-tax advantage share plans, you're going to end up paying income tax and maybe national insurance. And the same is true with remittances to the UK. So on that basis, that is quite important to deal with on that basis. As I say, small changes, large differences. This would be a comparison. Let's say I get detached duty relief. I end up paying no tax and employee NIC on the accommodation provided by the employer. And this is often the case where I have a short-term secondment somewhere. Whereas if I have a permanent place of employment, then I won't get any deduction for the accommodation. And as you can see, when I gross that up, as is often the case where the employer decides to pay the tax on behalf of the employee, you're ending up with a huge bill there. As I say, 124,000 or so tax and employee NI, and about another 36,000 of employer NI. So tax and employee NI, 124,000, employer NI, 36,453. So what you can see is small differences, particularly in the contractual terms. Is this really temporary? People moving to different countries, people having temporary secondments, employees can make a huge difference, particularly in terms of the availability of detached duty relief, which would give you potentially your housing, travel, subsistence and utilities tax-free. Let's look at pay as you earn. So I'm briefly going to look at that. What is the scope of pay as you earn? A UK employer, a UK employee, UK source earnings, employment related security gains. So if I make a gain on a share scheme, let's say I'm granted an option at £1, I exercise my right to buy the option when the value of the share is, I say, £5, I'll make a £4 gain, which probably, if it's related to my employment, will be subject to income tax and maybe national insurance. And also reimburse taxable expenses. So if I spend on something which is a taxable expense, let's say commuting costs, and my employer reimburses it for me, that element of the cash that I get would be subject to pay as you earn. So this isn't all the elements to be, you know, if I have a UK employee, even if it is a foreign employer, there would be a pay as you earn liability. And even if I wasn't a UK employer or a UK employee, but let's say foreign employer, foreign employee, but the income is UK source and not relieved by a double tax treaty, I will have a pay as you earn liability. So what you can see is it's not just based on the residence of the employer, not just based on the residence of the employee. You're going to look at putting through pay as you earn, UK source earnings, elements such as special arrangements in terms of shares. So they are liable to pay as you earn on a gain you make on an option scheme or a release of shares, and indeed reimburse taxable expenses. The leading case on this basis is Clark versus Oceanic, and that imposes or reinforces the point that there is a worldwide scope to pay as you earn, even if a non-UK employer, a non-UK national, but performs work in the UK, there would be pay as you earn. Let's take a good example of that. Let's say I am seconded to Singapore. I had a share scheme. I've done a year in the UK on an option scheme, and I then do a year in Germany, and then I do a year in in Singapore. So UK 1 year, Germany 1 year, Singapore 1 year. I exercise my options after 3 years. I have 90,000 of gain. What that means is, and it's on a strict time apportionment basis, 30,000 of the gain would relate to my time in the UK, and therefore 30,000 of the gain would be subject to income tax and potentially national insurance as well. Probably not NI, but definitely income tax, which means that I need to then put these people back on the payroll, reactivate them on the payroll, and tax it accordingly. Which means that you need to keep a track of where your employees are and where they've earned amounts of money, something that I may talk about a little bit later on in terms of sourcing. But even if I don't get to it, something to remind you that if it's UK source earnings, it is likely to be subject to pay as you earn. And as I say, the definition of earnings includes certain elements of share scheme gains, and indeed, if I have a benefit which is given in the form of cash or cash equivalent, like a cash voucher. Pay as you earn, generally done monthly. You need to fill in the real-time information. That has been a requirement for now over 10 years. So before you make the payment, you do the RTI return, and that also gives HMRC quite an interesting, gives HMRC a particularly useful way of tracking how people are being paid over a year. And it does, as I say, cover some vouchers and some benefits as well. So in looking at employment, I look at pay, benefits and bonuses. Let's look a little bit at the national insurance element. So why is national insurance different from tax? And forget all the people who say, oh, it's the same, it's just an additional tax. I mean, the treatment of it in the autumn statement last week proves beyond any reasonable doubt that it is looked at and treated differently by the government, and indeed in terms of law. If I look at the issues, if I have, do I get any benefits relating to my payments? For tax, no. No specific benefits to me for paying the tax. I don't get anything extra, not even a thank you note from HMRC. If I pay enough, I could be in the Sunday Times top taxpayer list, but I think I have some way to go. But with NI, national insurance, I need 35 years of either contributions or credits in order to get a full state pension. And you can look on your personal tax account to see how many years you've done. And in terms of other benefits, there are some benefits which are related to NI contributions. Other elements would be in terms of the assessment. Tax is assessed on an annual basis, normally in terms of a sweep up in your self-assessment tax return, whereas NI is on a pay period, which could be monthly, normally so, for some people weekly, but there is an adjustment for directors in that they're on an annual basis. So, for example, in terms of the primary NIC, for the bit between the 12,570 and the upper earnings limit, we're going to be looking at that on the basis of 9 months at 12% and 3 months at 10%. So effectively 11, what's it going to be? 3/4 of 2. So it's going to be a blended rate of the two, effectively 11.5% for directors on that basis. In terms of tax, is on a residence and earnings basis, with NI no receipts. With tax, it's on broad income. With NI, it's on earnings. What do I mean? In other words, one of the reasons why there was a national insurance reduction rather than an income tax reduction, one of the several, I think, last week, was that a tax reduction would have given benefits, say, to people who were getting dividends and potentially rental income, and the government wanted to concentrate it on workers and the self-employed. So it's based on earnings. Okay. In terms of recordings and so on, I think that the link will be available next week, and I will have changed the spelling of stationery on that basis before then. In terms of NIC, the other issues, benefits in kind are normally taxed. For where a benefit in kind is received and it is not a cash equivalent element, there is only employer-only NIC, Class 1A. And in terms of share gains, they're taxed, but the national insurance is only on readily convertible assets, i.e. quoted shares or shares for which there is a readily tradable market, i.e. normally unquoted shares isn't an issue on that basis. In terms of the international basis, tax and social security is contrasted. So tax is generally on an international basis dealt with under double tax treaties between individual states. There are very few multilateral double tax treaties, whereas social security is dealt with social security agreements, and the EEA covers at least 31 countries, the European Economic Area element. On tax, it's based on an earnings basis and residency quite often. So in other words, if I go abroad, it would be based on the earnings that I've earned in the UK. Whereas social security is what I call a bums on seat, a strict receipts basis. What is my status at the time I receive the social security? If I'm exempted or under another social security system, then I don't pay NI. So I could have a situation where, let's say I go to Singapore, I'm subject to social security for another 52 weeks because there isn't a social security agreement. So the UK imposes another 52 weeks of social security. But let's say I was paid a bonus in week 55, there may be tax on the basis it may be related to my UK duties, but there would be no social security because it's outside the period in which social security is levied. As I indicated, tax is on a wide range of income and capital, whereas social security is normally on earnings. And with tax, it may be apportioned between two states, whereas social security is based on insurances generally only in one state on that basis. Let me look at that a little bit further in terms of medical insurance. So the difference between a benefit in kind and a cash reimbursement. So here I decide to offer all my employees medical insurance, and I do the contract with Bupa, I as the employer. So there's a payment to Bupa, could be another organizations. There are other medical insurance organizations, and the contract is with the employer. And then I issue a cover note to the employee. This is a non-cash benefit to the employee, and therefore in terms of the medical insurance costs, the employer class 1A is 13.8% of the £1,000, 138 quid. For a basic rate of the tax would be 200, but no employee NIC. More expensive would be, I would say, right, you find your own medical insurance and you do a contract with Bupa. So there's a payment to Bupa by the employee gets an individual contract and the employer reimburses. That is more expensive because you get the same, but it's class 1 through the payroll national insurance. The same employee tax, though it's through pay as you earn, not under a self-assessment or tax code, but you now get up pops employee NIC, which at the moment would be £120, but in January would fall to £100. So a differential between them. Any questions on that before I move on to claiming deductions? So a reminder that in terms of claiming deductions, you do that in the performance of duties. And in terms of employees, that is wholly exclusively and necessarily in the performance of the duties. And in terms of the difference for the self-employed, it only needs to be wholly and exclusively. For employees, it needs to be necessarily in the performance of duties. So that is important because there are a number of expenses which the self-employed can claim, like travel to all sorts of events, which the and training, which the employee may find more difficult on a self-funded basis. Training is a good example. So HMRC will generally accept that if the employer pays for training, it is necessary. They may want to see that some training is being done on a structured basis. Whereas if the employee pays for the training and looks for a tax deduction, then HMRC will say, well, if the employer hasn't thought it necessary to pay for this, why should we give a tax deduction? Because the employer obviously hasn't thought it is necessary. And in the performance of duties gives it a time threshold or a time limitation, shall I say, that is not found in terms of the self-employed on that basis. Okay. So that's important in terms of the claiming of deductions principles in the performance of the duties, wholly, exclusively, necessarily. I think, you know, those two extra elements for employees make it much more difficult to claim those expenses. In terms of the calendar of events, when I look at calendar of events, 6th of July is very busy for my share scheme forms, the P11DB, and if I've made any termination payments plus benefits, I need to do a return. And indeed, a number of elements where the deadlines were 90 or 92 days have now been transferred to being by the 6th of July following the end of the tax year, including making good on certain benefits. Other dates, important payment of a second payment on account by an employee on their tax return, 31st of July. So that is on the tax liabilities of the previous tax year, if you know, you get large amounts of money which haven't been subject to withholding tax. Calculating the pay-as-you-earn settlement agreement, where the employer has decided to pay tax on behalf of the employee on certain benefits by the 31st of October, 19th of October, the payment of the PSA, and of course, 31st of January, submission of self-assessment returns and payments of balancing tax. If I look at the monthly events, there's an RTI submission, real-time information. Submissions are generally done on a monthly basis. The full payment submission required for every employee, and you need their full name, their gender, date of birth, full address, and national insurance number. And the only two things on that list that can't change is your date of birth and your national insurance number. Everything else can change. If I look at the types of compensation, so pay goes through the payroll, entry on the monthly deduction, tax is paid monthly except for smaller companies who can pay quarterly. So I do mine on a quarterly direct debit. NIC, class 1 employer and employee for pay, including reimbursed, as I say, where it's reimbursed benefits or share scheme gains, or other elements where it is directed, like non-cash vouchers, that it should go through the pay-as-you-earn system. Benefits on a P11D with self-assessment return, unless included in the tax code. When is tax paid? Annually on benefits, unless included in the tax code, or payrolling benefits, where you've included it in the payroll in order to take the tax out on a monthly basis. NIC on most benefits is class 1A, employer only. For expenses, P11D when not covered by a dispensation or agreement, on the P11DB, annually by self-assessment. And dispensations, generally speaking, got abolished some years ago. And what you tend to find is that they've been carried on in terms of individual agreements between the employer and the employee. NIC would be due when not covered by a claim for a deduction. Unapproved shares are reported on digital forms, go through the payroll, with the payroll month after the taxable event. And class 1 employer and employee NIC is due unless a 431 election is made to pay them up front. That's beyond the scope of the course, but sometimes people pay the tax up front on the initial value of the options or the shares, which means that any increase in value subsequent to that is only subject to capital gains tax. That's a fairly standard procedure that people go through. The risk is obviously if the shares fall in value, you don't get back the tax and NIC you paid up front. Bonuses on payroll, and there would be NIC unless you've gone abroad and they're covered by a certificate of coverage or exemption, which means that maybe you pay either foreign social security or none at all. Who pays? Always important to know. On a P11D benefit, the employee pays. Who pays NIC? The employer only. Gross up, and there's no gross ups because the employee is paying his or her own tax. With a payroll, again, the employee pays the tax. The difference between payroll and P11D is that you can see that in terms of NIC, whereas under a PLMD, it's an employer only charge, class 1A. Under payroll, it's employer and employee generally. And there's normally, but there's no gross up for tax on that. So you pay the tax. With a PSA, normally used for minor benefits or staff entertaining where there is a taxable charge, the employer pays the income tax. Who pays the NIC? Again, the employer only under class 1B. Is there a gross up? Yes. And as I pointed out in my example, in terms of the detached duty relief, that could be very expensive. In terms of who pays, I'll just get to the end of this section and then we'll take a shortened break. What you can see is the difference there in terms of income tax cost and NI cost on P11D and payroll. Let's assume this is an additional rate payer. The NI cost is only the 2% above the upper earnings limit for the employee. So it doesn't make a huge deal of difference between the PLMD and the payroll. But if the employer pays the tax on behalf of the employee, you can see the gross up cost nearly, effectively doubles the cost to the company in terms of the tax and the national insurance. The tax on a grossed up basis where the company is paying the tax on the tax, and the NI cost, class 1B, again, not only on the benefit, but on the tax, the additional tax that the employer is paying. And where to report benefits, so final point before we take a break. How benefits are provided, as I say, direct between the employer and provider. Major benefit, cars, medical insurance, cheap loans. Payroll, the employee lays out cash and is reimbursed. That will go through the payroll. Home telephone in employee's name and commuting costs and other extras. And PSA, the employer provides the benefits and pays the tax on that. Typical benefit for that would be staff entertaining. In terms of benefits and expenses, the element that you would think about there, business entertaining, business travel, fees and subscriptions to professional bodies, hire cars for business, business use of telephone, business expenses on business credit cards, business fuel and other. So those elements you would normally get a deduction for. Okay. It is now 11:03. We'll take a 7-minute break, and then we're going to talk about joining the company and the other issues involved. Okay, 7-minute break. sorry. So normally a company would insist that you go back to work. And I suppose the question would be, if she doesn't do any work, is this because it's a family company? And one of the elements you might get on that basis, would be a challenge to the deductibility of the expense in the business, because it's not for the purposes of doing the job required. Does that make sense? So I think if the person doesn't do any work, there may be challenges on the basis that, you know, what are you paying them for? Well, if you're only paying them because they're a member of the family, well, that isn't deductible for tax purposes in terms of the business. Hopefully that makes sense, especially when I remembered to go off mute. So one of the final elements I wanted to deal with just on expenses before we is that it's not a, you don't wholly exclusively necessary, isn't a reductant ad absurdum, as I would call it. So some apportionment is allowed on a fair and reasonable basis. So, you know, a lot of people say wholly exclusively necessary. That shouldn't allow any food on any conference or any business on the basis that you eat to live, not in the performance of duties. But, you know, revenue, HMRC will allow subsistence. They will allow accommodation, hotels. You know, one needs to sleep, but they'll still allow that. So there isn't a reductum ad absurdum. Some apportionment is allowed on a fair and reasonable basis. An employer has a major input on what is allowable. So they don't say, well, you don't need an office, you could go to the public library. If you choose to have an office, that is fine. And then the other bit, which sometimes surprises people, is, you know, whatever mode of travel takes you to the right place is what they're going to look at. So, for example, if the company policy is, which is quite a lot of companies' policies, I'm going to pay travel first class if you're traveling for more than, say, 3 or 4 hours, then that's fine. What you can't do is sort of trade down to second class and take the element of the trade down as being deductible. You know, if you have first class, if your employer gives you that, that is fully allowable, but you can't cash out part of the benefit. Okay. So let's move on. The sourcing I talked a little bit about before, but is important in terms of, you know, if you have an employment period and you're across several jurisdictions, what did you earn in those in that time across, say, Germany, Switzerland, and the UK? If with the arrows there where share options are granted, you know, the final one is only UK sourced, but the other two could be sourced on a time apportionment basis, part to Germany, part to Switzerland. In terms of share options granted, as I say, that could be a significant issue, or indeed bonuses. So with bonuses, I'm going to want to look at the bonuses awarded. What I'm looking at with bonuses is what is the measurement period. So even if the arrow shows when it's paid at the end of that period, what did the bonuses relate to? And maybe I'm in 2 or 3 bonus schemes. And again, it's important to look at the paperwork to see what it relates to. Inducement payments, normally taxable in exchange for starting employment, and the receipt would be taxed on the first day of employment. And in terms of relocation payments, although it's only a miserable £8,000, that hasn't changed since Michael Portillo was Financial Secretary to the Treasury back in the early 1990s. Qualifying would be travel to a new location, moving goods, temporary housing expenses and stamp duty. Non-qualifying would be lump sum payments. And again, in terms of recruitment of individuals, you're going to want to look at the terms on which this is done. I then move on to what I call entertainment and Puritanism. So I've got Franz Howell with the Laughing Cavalier now showing at the National Gallery, as opposed to Puritanism. And you do wonder whether HMRC take a somewhat puritanical approach on that basis. So is this entertainment or is this marketing? So if I go and try and sell cars at a motor show and I give out drinks and so on, is that just part of a marketing sales push, or is this business entertaining? Reasonable subsistence would be allowable, as would most costs in terms of promoting a new product. So let's say I have a sales launch. So important, because entertainment is not deductible for corporation tax purposes, but marketing is. What about allowable at conferences or meetings? So sandwiches should be fine. Attendance at conferences with all the, including training conferences, of course, with all the relevant expenditure, accommodation, travel, reasonable food would be allowable. What is not is generally alcohol. This is where the Puritanism comes in. You are allowed a reasonable amount of alcohol with your meal, but the moment you go to a bar or away from a meal, then that is not going to be allowable on that basis. If I look at annual functions, this is a good time to look at them. We've got our annual function for Mindell in a couple of weeks' time. You're allowed up to £150 per head, and that is each person attending. You could, of course, split it into two functions, say two of them at 75 quid each, and open to everybody who's an employee, or the equivalent is provided. And of course, when I talk about each person, that also includes, you know, the other halves or other people who are invited, you know, wives, girlfriends, boyfriends, husbands, etc. Of course, trivial benefits give me more. You know, how far can you push those? So let me look at the Q&A. Substantial meals, Scotch egg. We're back to coronavirus and all those regulations. Well, if I have a meal and, you know, it's a very small meal, I don't think I can get away with a whole bottle of wine. I think HMRC looks at sort of a half a bottle per person. What about having staff meetings to discuss the business work on a monthly basis at a restaurant, especially now everyone works from home and no office space? Well, I would wonder about the timing on that basis. Is it lunch or is it dinner? Why choose a restaurant? Can you discuss confidential matters there? There are all sorts of elements that you would need to think about. Are all, you know, I think that there are some problems with this, not because you can't get it in certain aspects, but I think it's a question of how far you push it. If there was any alcohol on the bill, I might wonder about whether it's a real staff meeting on that basis. Another elements. Alan has asked, if a payment is made under a long-term incentive plan after the employment has ceased, does this necessitate going back and reopening prior periods assessment, return and apportioning the payment to the fiscal year in which it was earned? No, that wouldn't be the case, because it's on a cash basis, but it is deemed to be received on the last day of your employment, generally speaking. So therefore, and the impact of that is depending on the type of payment, and it may be prorated for the period of measurement. You could be looking at the status of the individual in terms of residency on the last day of payment, which the last day of employment, which is what you would do for a terminal bonus. But in terms of an LTIP or something, if you pay out and you had a third of your time in the UK and therefore you were subject to tax on a third of it, you would still be taxed according to the rates in the year in which you receive the money. So let's say I earned the money in 2021, or it relates to my duties in 2021, but it's paid to me in 2025, then I'm taxed and would report it in my self-assessment tax return in 2025, according to my resident status or how I earned it in 2021. So take an example I had before: 1 year in the UK, 1 year in Germany, 1 year in Singapore. It then matures. So the 30,000 would be taxable in the year of the maturity. So I've got 90,000, 30,000 of which relates to UK duties, and that would be taxed when I receive it, but on an earnings basis. So in other words, the amount would relate to my UK duties. Hope that answers the question. So give me more how far to push it. And HMRC have been particularly concerned in this area. So conditions: the benefit is not a cash or cash voucher. Condition B, the benefit cost, either the cost of providing the benefit or the average cost to multiple recipients, does not exceed 50 quid. So a light lunch rather than a big one. Condition C, there's no salary sacrifice. Condition D, it is not a recognition of service, right? So, for example, I could take you all out and say it's Christmas and spend, say, 48 quid at a restaurant per person, and that would be okay. If I go like Grace Brothers all those years ago and say, you've all done very well and this is an extra reward for you doing well, that doesn't count in terms of trivial benefit. So it needs to be related to something that is not earnings basis. Of course, you've got the annual function as well you can use, which is 150 quid available to each individual. But in terms of trivial benefits, it's 50 quid or under and cannot be a reward for service on that basis. And then there's this additional restriction where you are participators in a closed company. Don't forget, personal incidental expenses not changed for now 40 years. For an overnight stay, you get 5 quid in the UK, and for an overnight stay overseas, you get 10. And that covers things like newspapers, some people still get them, or other incidentals, just about 1 drink at the bar if you're lucky on that basis. Tax-free benefits, always useful to look at. A canteen doesn't have to be a lavish affair. Annual parties, we talked about. Trivial benefits, equipment for disabled employees, so adaptations required. Health screening, if available to everybody. Late night taxis, do be careful that you don't abuse that area. So it needs to be a taxi from work, not you've gone out to a restaurant, you go back to the office and then order a taxi when you haven't been working. And long service awards within specific rules on that basis. Okay. So MTD, or making tax difficult, as I would call it, making tax difficult. Making tax digital. So quick reminder, the principles, and this has been almost since I started lecturing, I've been talking about MTD. The idea is quarterly reporting. At the moment, it's only needed at the moment, it's only needed for VAT returns. So the idea is quarterly reporting of income and expenses, but actually at the moment it's just needed to populate the VAT return. The idea is to have digital held information and digital accounts or spreadsheets with digital software on that basis. Now, with bridging software, I should say. Now, why is that important? Well, a lot of people think they've got to get everything digital, but actually that's not the case. They could just use a spreadsheet and buy bridging software, which then puts it on the portal. That may not be the case from 2026, when you won't just need Making Tax Digital for VAT reporting, you may need it for income tax reporting. The project seems to be delayed, partly because HMRC hasn't got their computer stuff in line, working yet. But there's been a review to this, and in the autumn statement, what they said is the previously announced dates of April 2026 for gross income turnover over 50,000 and April 2027 for gross income turnover over 30,000 remain. Future extension to business with gross income turnover will be kept under review. There will also be a number of simplifications. Quarterly reporting will change, although updates will still be every 3 months. These will now be on year-to-date figures. This avoids the need to put through amendments to previous quarters as envisaged in the original proposals. And there will no longer be a need to submit end-of-period statements. The final declaration will now suffice. And an easement will apply for landlords with jointly held property, and expenses for jointly held property may be submitted annually rather than quarterly with less detailed information required. So the idea is that they're worried about the tax gap, underreporting of income by small and medium-sized enterprises. This is a way of HMRC getting a better handle on this, but this project has been now delayed several times. So you could see the graffiti on the wall sooner or later by disgruntled accountants saying MTD has had more dates than I have, because it's been delayed so often. But it will come, I'm sure of it, because the government wants to reduce the tax gap, and they believe, whether it's right or not, that this is a very good way of reducing the tax gap. You've got an extra 2 years. It would be useful to review with clients how far they've got down the digital process. Do they have software that is MTD compliant, for example? I'm going to move on to VAT briefly, because I did say on the thing that I would deal with VAT. So to register or not to register, that is the question. So remember, VAT applied on goods and services, different rates of VAT, compulsory registration for taxable turnover over £85,000, and a voluntary choice below this. And the other element is that the VAT threshold is now effectively the same for MTD. So MTD is triggered at that point. The UK is different to other countries in terms of VAT in the wide range of items which are zero rated. And zero rated is, as Dr. Pangloss would have said, the best of all worlds. Why? Because you charge VAT at a zero rate, which means that the customer doesn't pay any VAT. But if you've paid VAT in producing or selling these products, you will get your VAT back on it. So food and milk, coffee, tea, cakes, most items in a supermarket, you can go through the till receipt, are zero rated. Children's clothes and footwear and baby wear, books, now including electronic publications, magazines and other publications, whether in paper or electronic format, newspapers, some medical products, and some products to do with energy efficiency. The interesting element is every year the government seems to now, now we've left the EU, expand the number of zero rated products. So the autumn statement, they announced about the installation of solar panels and other equipment, and heat pumps be zero rated, and indeed some medical products such as sanitary products and indeed sanitary pants as well are now included in zero rating. Exempt means that the customer is not charged VAT, well, not directly, but the supplier cannot reclaim VAT, which means that within the price you've got a hidden amount of VAT, And there you would look at insurance and many financial services. In terms of the 5% special rate, domestic energy saving devices, the ones that haven't now been moved to zero rating, helmets and protective wear, and some medical products. And then the standard rate, which is the default rate, is catering and hot food, including biscuits, energy for non-domestic use, alcoholic drinks, and as I say, chocolate covered biscuits and other biscuits as well now. So you get all these questions about whether Jaffa cakes are cakes or biscuits. They are cakes. In terms of the VAT process, just to explain quite briefly on this basis, you are paying the difference. So you pay for raw materials as a manufacturer and services, that would be input VAT. You charge for manufactured goods, hopefully it's a premium to that. And the difference between the VAT you pay and the VAT you charge would be given to HMRC. The output VAT of manufacturer becomes the input VAT of the wholesaler plus other costs. The wholesaler charges the retailer for goods plus output VAT. And again, it's the difference that goes to HMRC. The retailer, the charge by the wholesaler, becomes the input tax plus other charges, charges the customer output tax on the goods. And again, the difference, positive difference you would hope if they're making money, goes to HMRC. And of course, the end user, if they are, an individual non-VAT registered business or others like that, they don't reclaim the VAT. That's the simplified principle of it. In terms of the VAT cost, the VAT registered business, the VAT cost is the difference between the input and the output VAT. i.e., if I get in 60,000 of VAT and pay out 40,000 of VAT, my difference is 20,000. For a non-VAT registered business, the cost is the total VAT charge because I can't reclaim it. So do I go for things like voluntary registration? Well, voluntary registration might be a good idea if most goods supplied are zero rated, because obviously you get the input tax back and your customer is not suffering VAT. So a bookseller would almost always register for VAT because they're just going to get money back based on the electricity and other costs that they have VAT borne on them. Or if all your customers can reclaim VAT, then why not register for VAT and claim the input tax back? And you're not putting yourself at a competitive disadvantage. And of course, exports are generally zero rated. So again, exporters would voluntarily register for VAT. And indeed, exporters and those who supply zero rated goods that are zero rated for VAT sometimes do monthly VAT returns and that helps with the cash flow because they're getting constant checks back from HMRC. Obviously, it's not competitive to voluntarily register if the customers cannot reclaim VAT or customers have restrictions on reclaiming VAT because they are making exempt goods like banks and insurance companies. In terms of flat rate schemes and other types of schemes, cash accounting, 1.35 million is the turnover limit. So it just means you need to look at, did I receive the money in? And you're getting automatic relief for bad debts. Annual accounting, which I'm on, where I've got a year end of 31st of March. I need to do my annual VAT return by the 31st of May. And then I do 4 quarterly payments, July, October, and January, based on the last year's VAT. And I do a balancing payment on the 31st of May. To get flat rates, you would have to have a turnover of 150,000 or less. And the idea there is that you don't have to worry about the expenses apart from major capital elements. You don't reclaim VAT on input VAT, and you charge a percentage, or rather you charge your VAT as normal, Most of the VAT goes to HMRC, but you're able to keep a percentage, which is roughly equivalent to the input VAT that HMRC thinks you should have been able to reclaim. So it might be that you have a situation where you charge 50,000 in VAT, say 20,000 in VAT, and you're allowed to keep 3/4 of it. Sorry, you have to pay 15,000. You pay off 3/4 to HMRC, and you keep £5,000. So I charge you 20,000 under the flat rate scheme, and that depends on the industry I'm in. Maybe of the 20,000, 15,000 goes to HMRC, and 5,000 I keep as, you know, roughly equivalent to the input VAT I would have been able to reclaim. As I say, you pay a fixed rate of VAT over to HMRC based on your turnover. You keep the difference between what you charge your customers and pay over to HMRC. You can't reclaim the VAT on your purchases except for certain capital assets over £2,000. And to join the scheme, your VAT turnover must be less than £150,000, and you have to apply to HMRC. So the default is you look at your input and your output. This, you only look at the output, but you do have to apply to HMRC on that basis. In terms of recharges of VAT, what we're looking at there is you recharge expenses, travel, subsistence, and indirect costs. And even if those were zero rated, like transport. So let's say I traveled to Brighton earlier this week. I took a train. So the train costs me, I don't know, 26 quid or something. That's zero rated. But when I charge for my lecture, the train cost, I have to put VAT on it when I recharge that to the organization. There's no recharge on disbursements directly arranged for a client, for example, legal. If I arrange a solicitor to provide advice for a client, even if it goes through me, I don't have to put VAT on top. Any questions at that point? Before I move to what is, I think, the final subject, which is the guiding principles of international corporate tax. Oh, one Q&A. Flat rate scheme. What about the low cost trader transfer? Is that still in place? Yes. So you've got to look. You would still get an element back, but it's a lower element. So you do need to look. That's well beyond the scope of this course, at whether you are within the low cost trader scheme or whether you get a more generous element in terms of the flat rate. You know, might be as much as you know, it could be as high as you know, sort of a reclaim of 8%. So if I had 20,000, it could be as high as I keep 8,000. It could be as low as you know, 2,000 or 3,000. So one of the elements you have to look at is when you apply for flat rate, am I in the low cost trader scheme? But yes, it's still there. So guiding principles of international corporate tax. So these are two pictures I've taken by Embankment Station, and you've got the Blues and Royals, which is a family-owned coffee place, really face to face with the Starbucks across literally a few yards across the way. And the idea of international taxes, whatever else, the two organizations should be on a roughly comparable basis for tax. In other words, you shouldn't discriminate against the multinational, but you shouldn't give them an unfair advantage against a small one-person business or family-owned business, as the Blues and Royals coffee shop is. In terms of international tax principles on that basis, companies and businesses are subject to tax on their profits where their principal activities take place. Companies and businesses are also chargeable to profit corporate taxes where they are resident or where they have a permanent establishment. Taxes are imposed via domestic legislation. International treaties do not impose tax where it does not exist in domestic legislation. And double tax treaties can be used to eliminate double taxation, but cannot be used to impose a tax charge that does not exist in domestic legislation. More principles there. One of the important elements is the economic substance takes precedent over legal contracts if the two contradict each other, just like with IR35 and self-employment issues. If the reality is not the same as in the contract, I go for the reality. Employment considerations are separate to corporate taxes, but the location of staff may well create a corporate tax liability. A permanent establishment may lead to additional corporate taxes being due, and a company should not be subject to tax on more than 100% of its income. What do I mean by that? Well, let's say I have operations only in France and the UK. Let's say I make a £10 million profit. If the UK tax is half my profits, £5 million are subject to UK tax, the French should not tax more than the other 5 million of profits. So in other words, if I make 10 million in total, I shouldn't have, say, 12 million subject to tax. Who pays corporation tax? Reminder, it's if you're resident in the UK, the tests for residents are incorporated in the UK or managed and controlled in the UK. And that goes back to an old case called De Beers on that basis. And if you are developing or dealing in UK land, there are additional rules creating a liability on that basis. In terms of company resident, just to say that CT applies to your trading income, property income, profits on non-trading loan relationships, that's interest, miscellaneous income and chargeable gains, less any qualifying charitable donations. There used to be a schedule system where it went under Schedule A, B, C, and D, but they changed that with the tax rewrite, so you get the headings that I've put on the slides. In terms of the company residence, Lord Lawbow, in this case going back to 1906, but still relevant, company resides for the purpose of income tax. This is before CT was introduced, where its real business is carried out. I regard that as the true rule, and the real business is carried on where the central management and control actually abides. So that's a big issue for strategic management and also for company secretarial and HR. Where is the central management and control? The meeting place of the board of directors is important, but not conclusive. And directors may not actually exercise central management control. That could be the case, particularly with family arrangements. You've got to look, where are the shadow directors? And in terms of the subsidiaries, who are actually making the rules in terms of the subsidiaries. As I said, a company is chargeable to corporation tax in two situations. If it's resident in the UK, it's liable to tax on its worldwide income and profits. If it's not resident in the UK, but carries on a trade here through a permanent establishment, it's liable to corporation tax on the profits attributable to a PE. So let's say I was a French wine company and I decided, because of climate change, that I was going to establish some vineyards in Kent. They would be permanent establishment, and that PE in Kent would be subject to UK tax, but only on the activities of the permanent establishment. The other way in which a company can suffer withholding tax would be potentially withholding tax from the UK on payments of royalties and so on. Permanent establishments are, on that basis, very important. And in my view, it's a major issue for HR and non-tax specialists. Because permanent establishments are the building blocks for corporation tax and potentially creating pay-as-you-earn and social security liabilities, it's very important to get them right. There is a concept of trading in or trading with. So what am I looking at there? Well, a sales trip, I haven't established a permanent establishment. That would be trading with, and therefore not subject to corporate tax. I can send goods, I can have sales missions. That does not create a permanent establishment, nor would a conference, because that's of a temporary nature, or indeed a sales exhibition. Providing services, it would depend on the services. Warehousing, generally not, but a fixed space or manufacturing would be seen as trading in, and therefore potentially subject to corporation tax. And in identifying the problems, I'm going to look at, am I trading in more than one country, potentially tax in 2 countries? Do I live even temporarily in more than one country? Where are my costs charged? Are they charged to the local subsidiary, or are they charged back to the head office? And what are my activities? Are they main activities or other ones? Does having an employee working from home abroad create a PE? Edwin, yes, it can do. And this is an area of particular concern, something I will get to very, very shortly indeed. Why would that be the case? Well, let's have a look at some examples. If I've got an office with a landline, I store documents in that office, and I'm known to trade from that office, even if it's in my home, that could create a permanent establishment. Contrast that, as I say, with a travel show, an exhibition. That will not create a permanent establishment, because I'm just going to Frankfurt to sell cars. Even if I make a lot of money in those 2 weeks of the Frankfurt Motor Show or whatever it is, that would now not count as a permanent establishment, but an office in home could do. And indeed, you look at the model treaty on that basis, and you might think about an internet website. Even if my website is available in lots of countries and people order from it, that wouldn't create a PE, but potentially having my own server in another country or an internet service provider in another country, that could create a PE. That would depend on the terms of the interpretation by the relevant tax authority. But certainly in India, there is a particular concern about that. A permanent establishment, the definition is found in Corporation Tax Act 2010, and it's based on Article 5 of the Model OECD Treaty. That is an international treaty, and exists where a company either has a fixed place of business in the UK through which the business of the company is wholly or partly carried out, or an agent acting on behalf of the company which has and habitually exercises there the authority to do business on behalf of the company, irrespective of whether that is in an office or in their home. This does not include an agent of independent status, but they have recently circumscribed the rules in terms of agents of independent status, and that is much more unlikely. So permanent establishment would include a place of management. That could be anywhere, a branch, an office, a factory, a workshop, an installation or structure for the exploration of natural resources, and a mine, an oil or gas well. Well, I'm assuming most of you aren't in the energy area, but in terms of the place of management, branch, office, that's quite a wide element and goes beyond what people think would be normal. And in terms of the agent element, the element that I think is a real issue is that they've extended, so you can create a PE if you have an agent who doesn't sign contracts, but it's extended now, so in doing so habitually concludes contracts or habitually plays the principal role leading to the conclusion of contracts that are routinely concluded without material modification by the enterprise. So, I would look at, there are potential issues. What is the problem with this? Well, potentially, do you know what they're doing, apart from being distracted? So is the guy on the right having major thoughts, which are the management of the company, or have they got a situation where they're actually performing like sales functions on that basis? Let's have a look at some HMRC examples, which I think will deal with the question that we're looking at. And here, what I'd like is fingers on the buzzers. These were examples given by HMRC in guidance earlier this year. Do you think this creates a permanent establishment? So this is poll 1 on this, permanent or not permanent. So do you think that example 1 creates a PE? I would warn you that it depends is not the right answer in all cases. Okay. Shall we see who's voted on this? And the 50% who voted no are correct, because it's basically a personal plan and there's no permanency on that basis or any structure to it. So HMRC would say that does not create a PE. And that was quite useful because a lot of HR departments were restricting people from extending their holidays and doing some work. But they probably are a little overcautious now. What about example 2? Open the poll on that one. A French national with an English partner joins a French company on a permanent contract, which allows her to spend a fixed 3-month period each year working in the UK. What's the answer on that one, anybody? We got a poll for this? Should we take some answers, if I may? So vote now. And again, the majority is right. Almost certainly yes. You could say it depends, but generally speaking, there's a permanency and a structure. It's 3 months every year, and I think the likelihood is it would potentially create a PE. Let's look at example 3. Read that through. Alexei, Luca, and Sarah all work for a foreign entity in state C. They come to the UK on holiday for the same part of the year with their families, staying at different addresses. They're all permitted to stay on an additional 30 days to work in the UK by their employer using the office of a UK affiliate company as a base. So vote now. And the answer is correct. My goodness. Right. Each time the majority has been right. 73% of you voted no. And the answer is that is correct. HMRC says, again, it's not structured. They're just spending a little bit of time after their holiday. So no permanency or in that arrangement. What about example 4? So company T has a team of staff in its Zurich office. Over the course of 9 months, 6 staff are permitted to spend 6 weeks each in turn at an affiliate company's office in London working on a project. What would we look at there? Please vote. I think, again, with the majority, the likelihood is that there is a structure and permanency to this, which may well create an issue. On that basis, there may be a bit of wiggle room. So the one person who put "it depends" may not be wrong on that. But I would say that it's the idea of that project, which I think is it's a fairly structured project on that basis, and therefore real danger of creating a permanent establishment in the UK on that basis. Okay. Permitted but not required. Yes, but I think that the point I would make there is it's on a project which is structured in the UK, and therefore I think that there's a difference there. In other words, there is a project there, and I think that you could end up with the arrangements on that basis being seen as a PE. Okay, chat. True, but I'd be interested in what the project was. If it was construction, I definitely think you're going to end up with a potential PE there. So there are elements there that would need quite a lot of investigation on that basis. And that's just HMRC's view. So in the final 4 minutes and a bit, I might go just very little bit over time, not very much. Pillar 2. Pillar 2 is coming in for companies with turnover above 750 million euros at the end of this month. Now we're on the 1st of December, the end of this month, which is an effective global minimum corporation tax rate of 15%. 138 countries have signed into this inclusive framework, and that will make a big difference. It is all part of the base erosion profit shifting project. In other words, anti-base erosion profit shifting project, which is now 10 years old, but is in BEPS 2.0, and one of the really ambitious elements is to create this global minimum 15% tax rate. In terms of the foundations of international tax, you first of all look at domestic legislation. Then you can look at the regional rules, so members of the European Economic Area, which is the EU 27 plus Norway, Liechtenstein and Iceland. You can look at the OECD guidelines and then double tax treaties. But the point about base erosion profit shifting, or against it, is the idea is to tax profits where value is created. So if a CEO asked you about it, that's all you really need to say. Tax profits where value is created. However, the challenge is, in an increasingly interconnected world, national laws have not always kept pace with global corporations, fluid movements of capital, and the rise of the digital economy, leaving gaps that can be exploited to generate double non-taxation. And of course, you go back to the beginning, a multinational should not be treated worse or better than other elements, your domestic small competitors. So that's the idea there. And there were 15 specific solutions. And the idea was the 3 themes of this is coherence, improving the coherence of the international tax system, substance, that you look at the economic reality of transactions, and transparency, forcing multinationals to report more on that basis. I don't have time to go through the principles of the BEP, so it's there in your slide that you can look at. But what I would say is the big one they're looking at the moment is addressing the tax challenges of the digital economy. And we may look at that at a different session, maybe next year. The important element is that contract, again, is not king. If there is a difference between the behavior of the parties and the behavior of the parties and the economic reality, you always go for the economic reality on that basis. And as I would say, the future is OECD Pillar 2, 15% minimum corporation tax worldwide, phased in from the 31st of December 2023 and also later. A lot of countries are doing a lot of work on this, and what you'll see is a lot of them are planning that this starts at around about the 31st of December 2023 for counting periods with an income inclusion rule, and then they're phasing it in after that. The important element to understand this is a headline. If I've got a UK company, has a subsidiary with a profit of 10 million and an effective tax rate of 25% in jurisdiction B, that isn't going to be an issue. However, if you've got a subsidiary with a profit of 10 million and the effective tax rate is only 10%, then the UK company will have to pay a top up of 5% to UK tax authorities if the jurisdiction C does not impose it. So let's say I have a profit of 10 million and the effective tax rate in subsidiary C is 10%. I can't use the excess profits tax in other countries to subsidize it. I look at a country by country basis, and that would mean the UK company would have to pay another 500,000 to tax 5% of 10 million pounds. That is the future, and I'm sure we will cover that in a future course, maybe next year. At that point, thank you very much indeed. If you have any questions or comments, now is the time. There is my email address. There is my there's also my my website. This is, of course, K3 Hub, brought to you by Tolley's. I hope you've enjoyed the course. If you have, thank you very much. If you have any suggestions for new courses, please let K3 know. And I wish you all a very pleasant weekend. And indeed, if I don't speak to you before, a Merry Christmas and a Happy New Year.